Hello there. We're now on our final chapter for F3. So well done for getting this far. I know it's quite a lot of hard work. It is a big syllabus, F3, but it really does go some way in preparing you for the skills level, particularly the F7 exam. So it'll be well worth it in the end when you get those excellent results from doing your exam. Now, this final chapter is a very small chapter, but there's lots of important concepts and principles that we need to apply. Now, what we're going to look at in Chapter 19 is really syllabus areas A and B. Who regulates accounting, who sets the standards, and also the fundamental underlying concepts and principles that underpin accountancy as well. So although it's at the very start of the syllabus, I choose to do this at the end of the notes because I think it's better that you learn everything first and then you get to understand the principles once you know how to account for all the transactions. So there's no numbers, no accounting, just learning theory and principles in Chapter 19. These are very frequently tested, so don't think that this is not an important area of the syllabus. We must study a breadth of the syllabus to be prepared for every eventuality. So, what we're going to have a look at first is the framework, sometimes known as the conceptual framework. Now, the conceptual framework lays out all the underpinning concepts and principles that really is a basis for all the accounting of transactions that we do. And really, those transactions then appear in the financial statements. Now, in reality, you've seen quite a few of these principles already throughout the course. So this is really going to summarise those principles and also drill down into a few further principles as well. Now, the framework is developed by the International Accounting Standards Board, and they're the people who actually set the accounting standards, the rules. Now, the framework, or the conceptual framework, is not itself an accounting standard, nor can it override the requirements of an accounting standard. This is, if you like, best practice, all the good principles that we try and apply when preparing a set of financial statements. We'll have a look at who sets the standards and the framework in the next session. For now, we're going to have a look at the concepts and principles contained within this framework. So, the first thing we've got to think about is the underlying assumptions. Now, we saw these in the double entry bookkeeping chapter and also in the chapter on the financial statements. The two main underlying assumptions are going concern and accruals. Remember, with going concern, we always assume the business is going to continue on for the foreseeable future, unless we have good reason to believe that that may not be the case. So accounts are normally prepared on this going concern basis. Every set of accounts and financial statements you have done throughout this course, we have always applied that principle going concern. Now, if going concern does not apply, well then we really need to revalue all of the assets and liabilities in the statement of financial position to their forced sales value, i.e. value them on a breakup basis, not at cost that we've been seeing throughout the syllabus. You will always be asked to prepare accounts on going concern basis, and that's what you have been doing over the previous 18 chapters. If going concern does not apply, well then that's going to completely change the outlook of the financial statements, because in that case we know the business won't continue for the foreseeable future. But we always assume that it does, unless we have good reason to believe that it won't continue. So, we've already seen going concern. Now, we've seen the accruals concept many, many times throughout this course. We prepare all our financial statements, particularly the statement of comprehensive income, on the accruals basis, meaning that we recognise transactions when they occur, regardless of when cash is received or paid. Now, can you think of some times when you have applied this principle of going concern? Well, there's been lots of times. Sometimes the accruals concept is known as the matching concept. Okay, matching. So there's been loads of situations where we've done this. Credit sales and purchases. We recognise the income and expenses now. We don't wait for the cash to flow. Depreciation would be an example of matching. Matching the cost of using the machine in the period, the depreciation, against the revenue earned from using that machine in the period. Remember that chapter, accruals and prepayments? We recognise an expense or income in the period that they relate to, not necessarily the same time as when the cash flows. The cost of sales figure. Matching the true cost of all the goods that we sold against the revenue against those units that we sold. In other words, excluding closing inventory when calculating cost of sales. That again would be another example of the accruals concept coming into play. So you've seen it plenty of times, the accruals concept, and remember we sometimes call it matching. Other underlying assumptions. Well, we could have consistency. Whenever we record a transaction, we should record it consistently year on year. Okay, so we should always be consistent with our assumptions and policies. Okay, and the main reason we should be consistent with our choice of policy each year is mainly for trend analysis. So then your shareholders, potential investors can analyse a trend of performance year on year, but also to analyse your trend with maybe other businesses within the same industry as yours. We must be consistent and not change our minds every period about the way we want to, let's say, value our inventory. If we're going to choose a policy of using FIFO, we're going to stick to it and try and be consistent, unless there's good reason not to. Now, the other one is a fair presentation. Financial statements are required to give a fair presentation of financial position in the SFP and financial performance in the Statement of Comprehensive Income. Now, to achieve this fair presentation, we must follow accounting standards and apply the framework, apply these principles that we're looking at now. Sometimes referred to as a true and fair view. We want to give a true and fair view of the performance and position of an entity in the period. That would be fair presentation. And the way we can achieve that is by following accounting standards and also applying the framework. Now, the conceptual framework also gives and lays out what good quality of information we should give and how we should give good quality information. So to help give this fair presentation, the framework outlines 4 good qualitative characteristics that financial information should have. And we must always bear this in mind when we are choosing accounting policies, for example, revalue or leave in at cost, when we're trying to choose policies within the business. So, let's have a look at these qualitative characteristics. We're now going to look at relevance then as one of our qualitative characteristics. There's 4 of them. Relevance, we say that information must be relevant to influence the economic decisions of the users. In other words, information is relevant if it's going to sway an investor one way or another to invest in your entity, your business. Now, we must provide financial information that is relevant to influence the economic decisions of the users. Information should have a predictive value. And in order to enhance this predictive value, we must be able to give information to the user to give them the ability to predict future events of our business and to also do trend analysis. So let's write that down. Predictive value, giving users the ability to predict future events and to enable the users to do trend analysis. Like we did back in chapter 17 when we looked at interpretation. We did some trend analysis comparing last year to this year. By doing that trend analysis, it's going to give us that ability to maybe predict future events within the entity or future performance. But also, the financial statements must be relevant and give a confirmatory value. Okay? We can confirm reliably and currently what has already happened. So, we can confirm what has already happened and we can enhance this confirmatory value by maybe giving additional disclosure in the notes to the financial statements. Okay. So we can give extra disclosure to enhance this confirmatory value, which would then make those financial statements more relevant. Now, we can also make financial statements more relevant by using and adopting certain accounting policies. For example, in IAS 16, tangible non-current assets, do you remember the standard gave you a choice of leaving your asset in at its cost minus accumulated depreciation or revaluing it to today's market or fair value? Well, you could enhance this idea of relevance by choosing a policy of revaluation over historic cost, because you're using current, up-to-date values rather than using old historic figures. So you can also use accounting policies to enhance this qualitative characteristic, if you wish. Now, our next qualitative characteristic is reliability. Okay, reliability. We must prepare financial information that can give a fair presentation of the entity's financial performance. Remember, we want to give a true and fair view as to what has happened in the business in that accounting period. Now, we do have to follow some certain principles to ensure we enhance this characteristic of reliable financial statements. A lot of these you've already seen. So, to enhance reliability, we must prepare financial statements in good faith. Okay? That is faithful representation. We've got to do things honestly, okay, and prepare the financial statements in good faith to give the best quality information to the users of our financial statements. The information must also be neutral, free from bias. So free from the directors of the business trying to manipulate the results to make the results of the company more favourable, okay, and try and avoid that creative accounting. Well, if you're preparing the financial statements in good faith, you'd like to think that neutrality and being free from bias and being swayed one way or the other would come along with it. The next one, do you remember this? We saw this in the last chapter, substance over form. The commercial substance of a transaction must be reflected in the financial statements rather than merely its legal form. substance over form. We want to reflect the reality of what is happening with transactions in our business. Now, we've seen two situations where the substance of a transaction is not the same as its legal form, and therefore the reality of the situation, the substance, prevails over the legal form. So, can you remember? I already gave you a hint. Chapter 18 was all to do with group accounting and that single entity concept. We may legally own 80% of a subsidiary, but we control 100%. And as such, the control element is the prevailing aspect, the reality, and therefore we consolidate. But also we saw this with redeemable preference shares. Redeemable preference shares. So remember that although legally they are shares, because there is an obligation for the entity to buy those shares back a few years after they've been issued, that is merely a liability and not shares that the legal form is representing. So we've seen that twice over in this syllabus now. The next thing we have is completeness. And as the name suggests, all transactions that are material are in the financial statements. So no material errors or omissions. Now notice I've used this new word, material. Well, information is material, in other words significant, if its omission or misstatement could influence the user's economic decisions. Okay, so information is material if its omission or misstatement could influence the user's economic decisions. So in other words, items must be significant. Okay, so we're only thinking about transactions that are material, that would influence the user's decisions. So, if let's say that you've got a company that you're doing the accounts for, and they have, let's say, $10 million worth of profit in the year, but you forget to put in $100 worth of asset, is that material? Is that significant? Is it going to change your mind whether or not you're going to invest in that entity? And the answer is no. But if you, let's say, omitted $1 million worth of asset, then probably that would be material or significant. So, materiality is also another concept laid out in the framework. So we've got to make sure everything's complete and all material transactions are all there, no omissions. Now the final concept is prudence. To be cautious in your estimates, in your judgments. So, we've seen this a few times. Irrecoverable debts. And more specifically, the allowance for receivables. Now, the allowance for receivables, we put money aside and said, yes, this is our receivables balance, but possibly some of that might not be recoverable next year, doubtful debt. And that would be an application of prudence, setting aside money as the allowance for receivables, but also provisions that we talked about a few chapters ago. Providing for a future expense now, so we are warning the users about this potential expense that could happen and be incurred next year or in future years. Okay? And all of those principles will enhance that qualitative characteristic of reliability. Now, our third qualitative characteristic is comparability. Financial information must have the ability to be compared with other businesses in the sector and with our own previous set of financial statements in earlier years. So we must be able to compare our own performance over time, but also with other businesses within a similar industry. Now, we talked about consistency already, didn't we? Consistency in applying accounting policies. Now, most standards will tell you the policy that you must adopt, but sometimes you have a choice in policy. With IAS 2, inventory, you had the choice of using FIFO or weighted average cost to measure the cost of your asset. In IAS 16, tangible non-current assets, you had the option of valuing your asset at its depreciated historic cost, its carrying value, or revalue. Now, if you have a choice of policy, you've got to choose it, choose the one that is most relevant and is relevant to your business activities, but then once you've chosen it, you must stick to it, unless there is a good reason why you shouldn't. Now, you can also enhance comparability through adequate disclosure, usually disclosing your choice of policy, maybe even your reasons why you've chose FIFO over AVCO, let's say. And also, you'll have mandatory disclosures for certain transactions. So you have to disclose certain things to do with your tangible assets and your intangible assets. But also other mandatory disclosures would include things like disclosures on your inventory and how you formulated the cost. You also have to do mandatory disclosures on provisions, which we discussed in the accounting standards chapter, but also events after the reporting period. There would also be some mandatory disclosure requirements in order to give you greater comparability, so then users can see what has happened to these transactions between last year and this year. Now, you do need to know the contents of all those disclosure notes, and I would ask that you go and have a look at your study manual in the accounting standards chapter, and towards the end of the chapter we go into more detail about what those disclosure notes look like. Okay. Disclosure notes is one of those additions to the new F3 syllabus, so do make sure you have a brief read over that in your own time. So, comparability then, that is our third qualitative characteristic. Our fourth and final one is understandability. We should prepare financial statements and give information that is useful to users that have a reasonable business and accounting knowledge. So you're not going to prepare financial information that's so simple that even a 5-year-old child could read it with no financial experience. You've got to prepare information that's understandable for people that do have an idea of what financial statements look like and have a reasonable business and accounting knowledge. Okay? So, that doesn't mean, though, that we should make financial statements so understandable that we exclude complex transactions or events. We should still include those complex transactions, and there will be many as you go up the qualification. We shouldn't just exclude them. What we should do is give additional disclosure to enhance understandability. Okay? So, understandability then, preparing information that users can understand, that have a reasonable and business knowledge. Anything that's deemed to be a very complex transaction will give additional information. You must learn those qualitative characteristics and also the fundamental principles that underpin them. And there we have our conceptual framework, and we can see that we've applied this throughout this syllabus, and that's why we've left it to the end. So our final video then will be on who sets the standards and also who formulates this conceptual framework.